Without getting too far in the weeds, the main thing is, again, take your deduction at a high rate, pay back a portion of it at a lower rate at a future date and save the spread. And definitely don't pay a gain on your carpet.
Welcome to the Going Long Podcast. We're back once again to continue to help to educate you so that you feel much more comfortable as well as confident investing beyond your backyard. And I am your host, Billy Keels. And you know what? I am so excited to bring today's conversation to you because it is one that is literally going to potentially help you to save tens, if not hundreds of thousands, if not millions of dollars or currency or whatever you're listening to. But this is an amazing concept and I know you are going to love it. So you need to make sure that you listen to every single word of today's conversation. But you know what? Before we even go there, just a couple quick things. I know that you continue to come back, you continue to share the conversation, and I want to thank you for that. I also want to thank you for continuing to leave your honest written reviews as well as ratings. If you haven't had a chance to do that now, really appreciate it. Let us know what you'd like to see more of, what you'd like to see less of, so that we can make sure that the Going Long Podcast is your go-to podcast twice a week and that it is everything that you want. So I go through every single review and I make sure that the team and I are focused on making sure to bring you the most value possible. So with that stated, I know one of the things that comes up a lot is you want to go back and you want to check out some of the very first episodes so that you can kind of laugh at me when I was even stumbling more than I stumble now, which is, it's what happened. But if you want to find out even the early episodes, go to billykeels.com. Once you're there, go to the podcast tab and you can find every single episode, video version, audio version, show notes, all that kind of stuff. billykeels.com, go to the podcast tab and you will be able to get right there. Lastly, those of you that are accredited investors and you want to connect with other accredited investors, and you've heard me say this like 1,000 times and you're like, I think I want to do this. So go ahead and just make it really easy. Just take out your phone and send a really quick email to aiclub@billykeels.com. Say something in the headline, interested in joining, and just let me know. And you and I are actually going to connect and we are going to have a conversation. This club is for accredited investors. And we are going to talk about things that accredited investors are talking about. Ask any question you want, and we're going to answer a lot of them. And the ones that we don't have questions to, well, guess what? We're going to figure them out together. And also, if you want to gain access to deals that are very exclusive and for accredited investors, it's a great place for you to connect and be able to do that. So love to see you there. Love to receive the email and get in touch with you soon. So today is a subject that is really, really close to my heart. We're going to talk about some keywords, things that you may have heard, may have not heard of, but it's really about how can you not just make more money, keep more money, being able to use tools, and specifically a tool called Cost Segregation. The Cost Segregation tool is one of the things that you really need to understand more of. We've got a great guest who's going to talk to you about what it is, how you can use it to your advantage, being able to understand can everything be depreciated? Just some things, and if so, how is that looked at? What are the different ways to connect with cost segregation teams? Are they specialists? Do they connect with or work with your CPA? We're going to help to clear all these things up for you so you feel comfortable and confident to contact your CPA or your cost segregation specialist so that you can once again get to your goals much faster. So get out a pen and paper if you don't have it already, because today is one that you're really going to want to take notes on, because this conversation with our guest today is going to be awesome. So today is our conversation with Erik Oliver, and we're going to get to that just after this. Are you looking for a way to get to long distance investing success, but not spending all the effort? You want to do it in a way that's much faster and it doesn't cause as much pain? Well, listen, I can save you all of that stress. Just go to billykeels.com/7 mistakes and you can pick up your free PDF to help you on your road to long distance investing success. So if you want to know how to use this special tool to accelerate your ability to achieve financial freedom through long distance investing, then guess what? Today's the conversation that you're absolutely going to want to listen to until the very last word. You know why? Because today's guest, not only started his career, check this out. He started his career training managers how to appreciate great work in the workplace. That sounds really interesting. I want to find out more about that. He also afterwards went on to become the operations manager for a landscaping and as well as design company. And most recently, he is a regional manager at Cost Segregation Authority, LLC. It gives me great pleasure to welcome to today's conversation, Mr. Erik Oliver. Erik, welcome to the show, man.
Thanks, Billy. I'm great to be here.
Yeah, man, I'm really looking forward to the conversation. I heard you and I followed you, and you continue to help people understand more about this really, really interesting world and for anyone who is investing in tangible things. And I know you're going to really be able to help us out so much today. But you know what? Before we even kind of go down that rabbit hole, the first thing is everybody gets 5 questions, Erik. You know you're going to get 2 in the beginning, you're going to get 3 in the end, and in the middle, you're going to be adding lots of value to the Going Long family, but I have absolutely no idea which questions you'll be answering there in the middle. So you'll just have to bear with me a little bit. But if you're ready to get started, I would love for you to help the Going Long family understand, where exactly do you live in the U.S.?
Sure. So I reside in Salt Lake City, Utah. A lot of you guys have probably heard of it. It was home of the 2002 Winter Olympic Games. So great outdoor life here in Salt Lake. We've got the mountains. And then if you head down south, we've got Zion's National Park, which I'm sure a few of your listeners have either been or heard of Zion's. We've got actually 5 national parks here in Utah. So it's great. I was born and raised in Salt Lake and then headed to the East Coast to Richmond, Virginia, which is just outside of Washington, D.C., and then New York for a number of years, and then headed back west about 6 years ago.
All right. Fantastic. So wonderful Salt Lake City, which is absolutely amazing. And so, from there, I actually want to ask you the second question, just to also get us started here with some more positivity. Help us understand, what's the most positive thing that's happened to you in the last 24 hours?
That's a great question, Billy. So business-wise, I have to say, to brag a little bit, last month, the end of last month, which was yesterday, we've actually had the largest month in our company's history in terms of sales. So
wow,
we've been in business about 15 years, and we've made some changes recently, added some new folks, and streamlined a few processes. And so it was nice to see all that kind of come to fruition, and we're starting to take off. So that was great to see as we closed the month out yesterday.
All right. Fantastic. So congratulations and continue to take things to the next level. It's absolutely amazing. So appreciate you sharing that with us, Erik. And also too, I kind of give myself this impossible task, and that's to tell your whole backstory in, 1.5 seconds. Never gonna happen, right? Never gonna happen. So the Going Long family, they forgive me conversation after conversation. I hope you can forgive me too. But more importantly, I'm really hoping that you can help me by you telling your own backstory in your own words. And if you can also just think about a couple of the major decisions that you've made to get to this point in your journey. And then Erik, we'll see where the conversation goes from there.
Sure. So kind of, you had mentioned employee appreciation. That was kind of my first real career. I worked for a company called OC Tanner. They actually were the company that produced the gold medals for the 2022 or the 2002 Winter Olympics. So they're located. They're a national company, multinational company actually that's headquartered here in Salt Lake. And my job was going out and working with professionals in the HR department and trying to get them to understand the importance of recognizing your employees, saying please, saying thank you, the stuff that we all are taught as children, right? But sometimes in the workplace, we forget those principles. And so it was a great job. I loved the job. It really helped me kind of form my management skills in terms of how I treat people and the importance of, building a quality team and building, having respect and thanking and all those things that go along with that, and recognition in terms of recognizing great work that's been done. So that was kind of my first career. Then I headed to New York, lived in Long Island, New York for a number of years doing landscaping. So my father-in-law actually owns a landscaping company and was looking to retire. And so we went up there with the hopes of trying to learn the business and buy the business. I think my father-in-law decided he wasn't quite ready to retire after a number of years. So I think we kind of made things a little too easy for him. And he's like, hey, I can do this for another 10 years. So we're in good spirits, but we decided to head back to Salt Lake. We've got family here in Salt Lake. And so I was born and raised in Salt Lake, headed back here. Background is in accounting. My degree's in accounting. And so came across this job. Be honest with you, wasn't familiar with cost segregation. When I first applied, looked into it, sounded like a great opportunity. Nobody likes to pay taxes if we don't have to. And so there's understanding the tax law and being able to apply the tax law for all investors is important. So came across this job and have loved it. It's been a great job, learned a lot about real estate, learned a lot about taxes, and been doing it for about 6 years now.
Fantastic. So listen, and what you mentioned a lot of things. So I guess it sounds like you do things so well that, well, you just even extended your father-in-law's time to retirement for a while. So, hang on a second. So we've got lots that we can learn from you. And then when you talked about, everyone likes to pay whatever they need to pay in taxes, but not pay more than that. And so once again, as we talked about in the very beginning, is understanding the tools that you have at your disposal to be able to accelerate your ability to achieve financial freedom in whatever that way, shape, or form it presents itself. This is another one of those tools, right? And so this is one of the things that we've talked about before, but it's been a while since we've really talked about, the whole concept of cost segregation. Depending on when you're listening to this is probably one of the most important aspects of looking at your investment or looking at an investment portfolio. When you start thinking about things like the return or the risk-adjusted return, this is a major player, right? This is a major player because it's not just about how much money are you potentially going to make. It's about how much are you going to keep and being able to understand these tools. So Erik, like I said, it's been a while. So help us understand, if you could just make this like really basic 101, help us understand what is cost segregation and how should we be thinking about that from an active or passive investor's perspective?
Sure. So cost segregation, really all it is accelerated depreciation. So a lot of us, one of the benefits of getting into real estate is we're allowed to take these non-cash expenses called depreciation off of our income and reduce our taxable income every year. So when you buy properties, you either depreciate them over 27 and a half for residential properties or 39 years. So just to make the math easy, let's say you buy a $390,000 office building, and you're going to get a $10,000 write-off every year for the next 39 years. It's just straight division. Take 390 divided by 39, you get a $10,000 write-off every year off your taxable income. Mm-hmm. But what if we can accelerate that? I don't plan on holding that office building for 39 years. So what if I can front load some of those deductions and take them sooner? And let's say instead of getting a $10,000 deduction, what if I got a $100,000 deduction in the first year and maybe $8,000 every year thereafter? So I'm front loading, those deductions. And that's really all cost segregation is front loading that depreciation. The way that's done, Billy, is through an engineering-based study. And basically the IRS has laid out different depreciation schedules for different assets. For example, carpet is a 5-year asset. Carpet should be depreciated over 5 years. It doesn't last 39 years. The challenge is that when you buy a 39-year asset, when you buy an office building, you don't know the value of the carpet in that building, right? You're not just buying the walls and the land, you're buying carpet, you're buying shelving, you're buying countertops, cabinets, all kinds of stuff. And so a cost segregation study goes in and we segregate those costs into different buckets, for lack of a better word. And so we say, okay, when you bought that for $390,000, there was $20,000 or $40,000 worth of carpet in that building. Well, that $40,000, if we break that out and segregate that, now we get to depreciate that over the correct life, which is 5 years versus 39 years. And so that's how we're able to front load those depreciation expenses. And as you know, Billy, there's a number of reasons why, time value of money, inflation is a big one right now, especially here in the US. Inflation is a big topic. And so a dollar today is worth way more than a dollar, tomorrow or a year from now, or even 39 years from now. So give me my deductions today and let's take advantage of those.
And so, yeah, and you bring up some concepts that are very, very important. And I think a lot of times when investors are looking for returns, they're typically looking for, what is the percentage return? But I think there are kind of a couple of words that they should put in front, which is what is the risk-adjusted return, meaning, part, and however you can look at that a number of different ways, but depending on how quickly are you able to get the capital that you placed, and then from there, everything is pretty much infinite. So when you can do anything to, as you talked about, front load the amount of capital that you're able to keep, then it helps your position potentially in a specific investment. And so when you're saying to me that you use the example of the carpet, I don't think a lot of people really think about that, but maybe, and I know you did high level talk about it, but what are some of the things that more than can be depreciated, maybe just at the first level, like what things cannot even be depreciated, not much less cost segregation, but are there any things in a property that cannot actually be depreciated?
Yeah. So when you buy an asset, you don't get to depreciate the land. So let's say you pay $1 million for an asset. Your what we call depreciable basis, the number you start with, is your purchase price minus the land value. So these are tangible physical things that go down in value over time. And the IRS looks at it and says land does not go down in value. And so you always have to back your land out of your equation when in terms of calculating your depreciation.
Okay. And that makes a lot of sense. And I'm just going to say this as a kind of an overriding statement just before, like Erik and I are probably going to use some examples. We're going to talk about concepts or frameworks. By no way, shape, or form are we giving anybody any tax advice in any part of this conversation. So what we are talking about, once again, are examples, some frameworks, and we are recommending that any of this that you reach out to, well, Erik, for example, or a qualified professional, as well as your tax professional. So you can see how this actually works for your specific situation. So with that kind of stated, Erik, so if we use that as an example, and I think you did before, but I just want to maybe change it a little bit. So if you purchase a property, that property you purchase it's $1.2 million. And we say 200,000 of that is actually applied to the land. So what you're saying is of the 1.2 million in that example, you would potentially be able to depreciate a million, because the other 200,000 is actually land, and land is not depreciable. Did I understand that correctly?
Yep, that's exactly right. Your depreciable basis would be the 1 million. And so that's what you would divide by either 39 or 27.5 should you take your straight line deduction without doing cost segregation. That's exactly right.
Okay, perfect. So now we're within that million. And just to help, within that million, it sounded like there are certain things that maybe are a straight line or over time, like the 39, we'll use the 39 years because we're talking about, let's say, commercial real estate. But are all of that million treated exactly the same? Or are there certain things that are able to be cost segregated versus there's some things that are not able to be cost segregated?
Yeah, no, that's a great question, Billy. So it shouldn't be treated the same. Unfortunately, a lot of us treat it the same, right? We buy a 39-year asset. We take the 200,000 out for land. We give our CPA the closing statement, and they put it on the books as one big asset, 39 years, and you take your straight line deduction. But like I mentioned, you're really not just buying one big asset. You're not buying just walls and land. You're buying carpet. You're buying countertop. There's all these different things. And so to give you an idea, we typically segregate into 4 categories: 5-year assets, 7-year assets, 15-year assets, and the rest of it remains in that 39-year category. So just to give you an example, all your 5-year assets are interior, things like carpet, window coverings, appliances, shelving, specialty plumbing, specialty electrical. Those are what we're looking for and pulling those costs out for the 5-year assets. The 7-year assets, you don't see a lot of it. It's usually your telecommunications, phone lines, cable lines, those type of things. Your 15-year assets are all your exterior land improvements. So curbs, gutters, asphalt. Again, if you buy an office building for $1 million, you're also buying a parking lot with that, right? And that asphalt doesn't last 39 years. And so that asphalt, according to the IRS, is a 15-year asset. So asphalt, curbs, gutters, irrigation, signage, outdoor lighting, fencing, all those things should be categorized as 15-year assets. So when you break all those up and you start depreciating that big chunk over 5 years and that big chunk over 15 years, now you're front loading and putting that depreciation in those early years.
And so when you're doing that, you're putting the depreciation in the early years. Once again, it's just from a mechanics perspective. In this type of example, that means that you would have this non-cash expense that would actually impact the amount of money that you would potentially be able to keep or write off. Is that correct?
Yeah. So this non-cash expense that we're creating, when we're front loading it, instead of getting, in a $1 million example, instead of getting, I don't know, I can't do that math in my head, Billy.
Well, you can change it. You can make it easier.
Whatever $1 million divided by 39 is, let's say it's 80,000. Instead of getting that $80,000 write-off in the first year, you're going to get a $150,000 write-off. And so now what that write-off is let's say I have 500,000 of income. Instead of me being taxed on 500,000, I get to reduce that taxable income by that 150,000. So now I'm only taxed on 350,000, which that equates, like you said, into an actual tax savings or dollar for dollar savings. And now I'm able to reduce my taxable income, pay less taxes. And so we're seeing in the current framework that we're in now with some of the provisions, and I think we'll talk here in a second about bonus depreciation, but Oftentimes you can get a good portion of your down payment back in the first year. So, you think about that $1 million asset. If you put 200,000 down on that, and all of a sudden you're saving 100,000 in taxes in your first year, you just got 100,000 back of your down payment. And so, like you were saying, as you start to run the numbers on this stuff, it's quite fascinating.
Yeah. And so then I guess kind of the big question that most people, as they're making dinner or running on the treadmill or running at 4:30 in the morning, whatever they're doing right now, is probably thinking, well, you know what? So why doesn't everybody just do this? It seems to make sense. Why doesn't everybody do this, Erik?
That's a great question. And I think I've finally gotten the answer after doing this for 6 years. I've talked to a number of CPAs and I've asked them that question. I said, hey, I know you've referred a few clients over to us. I know you work with, 1,500 clients. You've only referred a couple. I know you've got other clients that own real estate. Why haven't you referred those clients over? I think they could save some money on by doing some of these things. And the answer I get is, they said, Erik, I've got 1,400 tax returns to do by April 15th. I've got 9 IRS audits sitting on my desk. I can't stop and do cost segregation. First of all, CPAs don't have the skill set. CPAs definitely have the tax knowledge. The side that they don't have is the construction or the engineering side to be able to reverse engineer some of these buildings and put cost to it. And so that's why they don't do it internally. There's very few CPA companies that have an internal department that does that. They usually have to outsource to somebody who specializes in that. Mm-hmm. So CPAs don't do it themselves, but then they also it's a bandwidth issue. They don't have the time. And so adding to that, and this is probably one of the most important things I've learned in my short time doing this, is that there's a huge difference between a tax preparer and a tax strategist or a tax manager who manages those deductions. And so,
okay. Sorry, Erik, can you please repeat that one more time? Yes. I just want to make sure everybody heard that.
Yes. A lot of us use tax preparers to prepare our taxes. And what they're doing is they're taking all the paperwork you give them, they're filling out the tax side, and they're submitting it. Then you've got tax strategists or tax managers who are looking at your situation and say, okay, Billy, you've had X amount of income. You've got these other properties. What can we do to get your income down? What are the strategies we can use? And so there's a huge difference. And you pay, they're not cheap, but trust me, whatever you pay your tax strategist is going to be, you're going to save tenfold in terms of taxes. And so it's always important when you're looking at CPAs, do you have a tax preparer who's just taking your stuff, inputting it and submitting it? Or do you have somebody who's meeting with you quarterly saying, hey, what does your income look like this year? What other projects do you have on the horizon? How can we offset some of these liabilities? And so very important concept in terms of, that's why I don't see a lot of people doing it.
Okay. So it sounds like, number one, it's kind of like people are very, very overwhelmed and potentially say, hey, look, I've got to get through this other stuff. It's probably going to give me a higher billing rate or whatever. And other people don't know it. So what you're helping us to do, number one, Erik, is kind of shine a light on that so that people understand that, hey, listen, this is something that you should be asking for. If your team is not already talking to you about this, you should be talking to your team about this. And then the other thing is, and it's just a concept that I want the Going Long family just to think about, right? When you were talking about the tax preparer versus the tax strategist. Now, there is a rightful place for each one of these roles. But my question to the Going Long family is, would you prefer to pay $49.99 and then after you do the $49.99 or $29.99 or $100.99, and then you end up paying $700, $1,000, $3,000, $20,000 in taxes, right? Or would you rather pay $4,000, $5,000 and get a $30,000, $50,000, $100,000 tax credit?
Right.
I guess the question, it's up to you, but you need to make the choice. But what Erik and I are talking about is giving you the tools to go out and ask the questions that are going to allow you to get to your freedom faster, right? Is another tool that we're talking about. Wow, don't you just love this conversation? This is amazing. This is fantastic. And so just really quickly, I just wanted to remind you, for those of you that are looking to create more options for yourself, get there faster, and do that with long distance investing, make sure that you go to billykeels.com/7 mistakes to avoid so that you can avoid all those mistakes, get to your goals faster and sooner. Once again, that's billykeels.com/7 mistakes to avoid. Now back to the conversation. One of the things that you talked about, yes, this is something that this is an additional service So there is an additional cost or investment, depending on how people want to look at it. I like to think of it as an investment because if it's going to help you to get your cash sooner, even better. But you talked about something before I even go to, or before we get to the other question, you mentioned this concept called bonus depreciation. It's a word or two words that I absolutely love. They have made wonderful positive impact for me and for my investors. So it's phenomenal. And depending on when you're listening to this, Going Long Family, I'd like for Erik, for you to talk about kind of where we are. Because today and I'll timestamp this, we're in February of 2022, and we are thinking about this concept called bonus depreciation. Maybe talk to us about what it is and talk to us about the reality of what is happening with bonus depreciation in the coming years with its wind down.
Sure. So bonus depreciation has been around for a while, and it was used by the IRS to kind of stimulate the economy. So depending on how the economy was doing, they would say, okay, we're going to allow 50% bonus. And then they're like, well, the economy's not doing great, so we're going to bump that up to 80 this year. And so they kind of would use this as a tool to kind of stimulate the economy. And what it was meant for originally, I don't even think it had real estate in mind, because one of the provisions with this bonus depreciation is it only applies to assets with a 20-year useful life or less. So you think about real estate, we talked about residential's 27 and a half, commercial's 39. So how does that really apply? Well, the idea was if you go out and buy a bulldozer, let's say I've got a construction company and I go out and buy a bulldozer, and that bulldozer is a 15-year asset, the IRS would let me depreciate. Let's say the bonus depreciation period was 80%. They would let me take 80% of my depreciation in the first year, and the other 20% would be depreciated over the next 14 years in that example. So that was bonus depreciation. It's been around for a number of years. A couple things happened recently. In 2017, Trump came along and revised the tax code. And obviously, Trump is a real estate investor, owns a lot of real estate, understands how bonus depreciation applies in real estate, and made a couple changes. The first thing is that no longer has to be what they call new construction. So in the past, bonus only applied to brand new construction. Now, it applies to any building. So if you buy a building that was built in 1970, you're still eligible for bonus under the current provisions. The second thing that was changed, which was huge, was bonus is now 100% versus what it was in the past of 50%. So now, remember, 100% bonus on any asset under 20 years. Well, again, a lot of CPAs, and I think this is why some CPAs still are hitting the mark here in terms of talking cost segregation, is they're like, well, bonus doesn't apply. That's for bulldozers and machinery. It doesn't apply to real estate, right? It's like, well, actually it does. If you do a cost segregation study, remember we talked about those four categories, Billy, 5, 7, 15, and 27 and a half year. Well, your 5, 7, and 15-year assets, those are all under 20 years. So now that same $1 million building you buy, we typically segregate somewhere around 30%, depending on the asset class, but let's just use 30%. So we buy a $1.2 million building. We take out $200,000 for land because that's non-depreciable. So now we've got $1 million worth of depreciable basis. Well, if we come in and segregate about 30% of that into shorter asset lives, things like carpet, countertops, parking lots, et cetera, and you get 100% of that depreciation in the first year, that $1 million asset just got you a $300,000 write-off. So again, depending on what tax bracket you're in and where you reside, a $300,000 tax bracket, that's $100,000 minimum in tax savings, state and federal combined. And so these deductions are huge. So I'll touch on that. That's what bonus depreciation is. You asked another great question, which is, where is this going? Yep. And that is bonus depreciation is phasing out. So anything purchased between September 27th of 2017 and the end of this year is eligible for 100% bonus.
Sorry, and I think it's really important what you just said. So you just said something that's going to lead me to another question. Can you repeat the start date, please?
Yes, September 27th of 2017.
Okay. Through December 31st.
Don't ask me why. I hope your follow-up question is not why is it September 27th. The only thing I can think is somebody in Congress bought a property on the 26th or the 28th, I guess I should say. And so it's a weird date, but that's when it started.
Okay, September 27th, 2017 through December 31st, 2022. and that would be 100% bonus depreciation. So then does that mean, Erik, at the end of, on January 1st, 2023, that there's no more bonus depreciation and everybody should go home crying, or what do we do then?
No, actually, so the bonus depreciation law applies to when you put the asset into service. So bonus depreciation does start to phase out starting in 2023, drops to 80%, and then it goes down 20% every year until 2027, it'll be zero. So anything purchased next year in 2023 is eligible for 80%. So again, you're going to take 80% of your deductions in the first year. That remaining 20% is going to play out over 5, 7, or 15 years. And so, no, there's still a lot of good years left of bonus. And the great news with cost segregation, and we haven't really touched on this, Billy, but cost segregation is a real flexible tool. You can just keep it in your back pocket and use it when you need it.
Yeah, that's exactly the. So this was the reason that you mentioned before, just September 27, 2017. And so, yes, there's a phase out that will happen with bonus depreciation. Absolutely. For those people that are interested in 100% is better than 80%, of course. And, there are things you can do to accelerate even that. And so, but you need to speak to your tax professional, of course. But let's say that I purchased something in the past, and now you're talking to me about this whole cost segregation. I'm listening to this, it's still 2022, but it's later on in the year, but I made this major purchase back in 2020. Like, when do I know when it's appropriate to look at a cost segregation study to see if there's anything that I maybe potentially left on the table in the past? Like, if I'm just doing that kind of cost benefit analysis, number one, is it even possible to go back to the past to do that? And number two, kind of what should some of my criteria be to see if it would potentially make sense?
Yeah, sure. That's a great question. So yes, the IRS actually does allow you to go back without even amending a tax return, which is great. So there's a form, it's a 3115 tax form. It's provided as part of our study. And basically what that's telling the IRS is, hey, I put this property in service back in 2018. I didn't need the deductions back then, or maybe I wasn't aware of cost segregation back in 18. I need those deductions in 2022. And so it allows you, that form basically says, hey, I've been taking my straight line standard deduction. I'm now going to accelerate my deductions. And here's the difference in those two numbers. And you get to drop that on your current tax return without having to amend any prior years, which is great. And so, if you've got properties, one is, what was your purchase price? Because that obviously plays a big impact on how much depreciation you're going to get. And two, what was the bonus law at the time you purchased it? Because that's the other thing is, let's say you don't do cost segregation until 2024 and bonus is at 60%. If you bought the property in 2022 when it was still 100% bonus, you still get your 100% bonus. So the law applies to when you put the property in service, which is great.
Which is fantastic. So in that whole in-service, placing an asset in service is something that is really important, something that you need to speak with your CPA about, understand that. Some people may be thinking to themselves, okay, well, Erik, you talked about Form 3115, you talked about the CPA, but then there's a cost segregation company. Like, how do the teams play together? Do they play together? Because someone's probably thinking, wow, this sounds really, really cool, but where do I go? CPA? Do I call Erik? Do they play together? What? Maybe talk us through a little bit of how that typically will work.
No,
or how it works best is probably the best thing.
How it works best is getting both people involved, because I don't know your full tax picture, right? So there may be carry forward from previous years. You may have some passive investments where you're getting K1s and you're getting big deductions that I'm not aware of. And so we definitely want to get everybody involved early. One thing that we do, and most cost segregation companies will do, is we provide a free benefit analysis. And so usually when investors call me, I'll provide the free benefit analysis. And then I say, hey, share this information with your CPA and get their buy-in. And if they have any questions, let's jump on a call together, because I can help. Again, CPAs are kind of like general practitioners. They know a little bit about a whole wide array of subjects, but they don't always dive deep into real estate, or they don't dive deep into depreciation, just because they don't have the bandwidth. And so we're kind of the heart surgeon, and they're the general practitioner just on this, on depreciation. So get me involved. We'll get on a call with your CPA, answer any questions they may have. And then as a team, we'll come up and say, yeah, this is a great time to do this. Or you know what, maybe you don't have great income this year. Let's hold off and let's use it next year. Or let's just keep it in our pocket. It's not ever a matter of if cost segregation should be played. It's always a matter of when. When is the right time? Yeah.
I love that. Okay. So one of the other things in Eric, so I'm playing this out in my mind, right?
Sure.
We had an example. It sounds like I get this $1 million building. We or 1.2 million. We can depreciate $1 million. Has depreciable assets. It then sounds from that $1 million, we can roughly take 30% or 300,000 that we can accelerate some of that depreciation on, just as an idea. So let's say, Eric, let's do all this, and we accelerate every single thing as quickly as possible. And we're in year 7, and we still are holding on to the asset. And so, but we've depreciated every single thing that it was possible to depreciate that we could. And so there's this kind of word that I've heard in the past, and maybe you could talk to us a little bit about it. It's called recapture. And usually when I hear that word, people's eyes kind of go up like, oh, recapture. And so if you're not watching the video version, you should probably come check it out, because Eric and I just kind of made this really interesting face. But anyway, so talk to us about recapture. What is that, and how could that potentially affect someone in an investment that they would make where bonus depreciation or where accelerated depreciation or cost segregation is being utilized?
Yeah, no, that's a great question. And that's a question we get quite often. So when you sell an asset, you have to pay two types of taxes. You pay a capital gains tax and you pay a recapture tax. And the recapture tax is based upon how much depreciation you've taken. And so people always will ask me, Eric, isn't this just a timing thing? Why do I want to take all my depreciation up front if I have to turn around and pay it all back when I sell the asset? And I'll kind of back into the answer here. If you don't do cost segregation, I want you to think about this. If you don't do cost segregation, and let's say you buy that $1 million asset we talked about, so you buy it for $1 million, and let's say you sell it 7 years later for $2 million. Okay, market's great, everything doubled in value, that's great. I'm going to sell it, I'm going to take home this $1 million of cash, and everything's going to be great. Well, no, you're not going to take home $1 million of cash because the IRS wants their share, right? So you got to give them a big portion of that. You got to write a big check. But everything didn't really double in value. Your land and your walls doubled in value, but is your carpet worth more 7 years later than it was when you bought it? Did it double? It's stained. It's got wine stains all over it. It's dirty. It's not worth double what you paid for it, right? Carpet goes down in value. Your countertops, your cabinets, those all go down in value. Even your driveway, your parking lot is worth less today than it was when it was fresh new asphalt 7 years ago. Mm-hmm. So if you don't do cost segregation, when you go to pay that tax bill, you're telling the IRS everything doubled in value, and here, let me pay you on that doubling. Well, that's not, you're overpaying taxes because your carpet goes down in value. But if you don't have your carpet broken out, if you just have one asset, one big lump sum, you don't know what the value of the carpet is. And so you can't pull that out of the equation. And so that's why cost segregation allows you to allocate the sales price to the right buckets. Your land went up in value, your walls went up in value, but certainly your carpet didn't go up in value over those 7 years. Carpet goes down in value. And so that's why, and I'll kind of summarize this without getting too far in the weeds, but the whole idea behind cost segregation, there's a rate arbitrage that we're playing here as well. So you're taking your deduction against your ordinary income rate today, and that could be anywhere from 37%, federal, and then when you start to add the state on there, it could be anywhere. California's up to almost 50%.
Yeah. New Jersey's there with them as well.
Yeah, New Jersey, New York, those states. So you're taking your deduction at those 35 to 45% rates, paying back a portion of it, and that portion is dependent upon how long you own it, paying back a portion at a capital gain rate of 20% and saving the spread. And so that's without getting too far in the weeds, the main thing is, again, take your deduction at a high rate, pay back a portion of it at a lower rate at a future date and save the spread. And definitely don't pay a gain on your carpet.
Yeah. So that, and it was a funny one. So I was making the funny face and I was talking about what happens at the end of the 7 years. And what I meant to say is that we're selling at that point in time, because that's when your recapture stuff comes in. Yeah. So thank you for picking that up for me. And I shouldn't make so many faces. But then the other thing is, and it's to the point, and just reiterating once again, I mean, Eric is painting a picture of exactly, for those of you as you're thinking about, okay, your active income, your passive income, the way that they're being generated, and also making sure that your tax professionals are working with your team of cost segregation specialists so that you can legally pay what you need to pay, and that you also understand what tools are available, once again, to accelerate your ability to achieve the level of freedom that you're looking for. And so I love that example, and you painted it just perfectly, Eric. Before we go, because I've got to ask you the going long final three. Almost forgot about that. Anything else you wanted to leave us with, maybe that we haven't talked about? Because I think this is very beneficial conversation, but maybe there's a hot topic that I didn't ask about that that the going long family needs to hear about.
No, I think we hit most of them. Like I said, bonus, obviously sunsetting. We kind of don't know what's going to happen, as we go through the elections and we have new administrations come on. So we'll just kind of have to sit tight and wait there.
Yep.
But the main thing is just get with like you said, get with your tax preparer. If they're not talking about this stuff, if you're paying taxes and own real estate, talk to your tax preparer and say, hey, is cost segregation an option? What are your thoughts on it? Like you mentioned, we do a free benefit analysis. Get the analysis done so you can say, okay, here's what I have available to me. And then, based on your portfolio, you can go back to your CPA and say, hey, which of these properties do we want to do this year so that we can reduce that tax liability? Because right now, with the provisions that were put in place by Trump and him being a real estate professional, if you own real estate, you shouldn't be paying a lot of taxes right now because the laws are so favorable to you. So if you are, definitely talk to your CPA and see if there's something that can be done.
Yeah, I was going to say, if you are, that's exactly what Erik mentioned earlier. You need to not talk to the preparer. You need to find a strategist, talk to your tax strategist, make sure that they are actually, they've taken a look at it. Erik's given you some options here as well to be able to reach out to him when it makes sense. I do like that because as people who are investing in real estate or any real asset, is to really take a look at the way that the laws are written today and continue to watch this space, because we're talking about something the way that the laws are written today and the sunset, who knows, in the future that could change. So that's where we have to keep our finger on the pulse. So with that, Erik, the thing is, man, we've got to get to the going long final three, but I never ask any of our guests the going long final three unless you tell me, because today you're our special guest, that you're ready for me to ask you the going long final three. Are you ready?
Yes, I'm ready.
All right. I knew you'd be ready. Here we go. So we started with you over in beautiful Salt Lake City. I'd like to bring it back this way over to my new adopted side of the pond. Although I'm from Ohio, Barcelona, Spain is now home for me. But help us understand, what is your favorite European city that you've either visited or is still on your bucket list to visit?
So I want to go to Calabria, Italy, which is in the southern part of Italy. And that is, the reason is I've had family members go there. That's where my dad's side of the family originated from. So I've still got cousins over there. My last name is actually Oliverio, but when they came here to the States, they dropped the O. Now it's Oliver. So I've got some Oliverio cousins. So I don't know if any of them are listening, but
the Calabresi, yes, which is fantastic. Beautiful, beautiful part of Italy. I used to live in Italy as well, but I didn't I didn't live in Calabria, but I live in Sardinia, which was fantastic. Yeah, wonderful, wonderful. So Calabria, which is a wonderful, wonderful area in Italy. So appreciate you sharing that.
Sure.
And here's the next question I have for you. It's really about an experience, or I guess things that I've noticed from really successful people, and I consider you to be someone who's very successful. You're continuing to impact people's lives and help them in many ways. And one of the things that I've noticed, Erik, is that really successful people, unlike most people, like they get things right the very first time that they try it. So they're able to go I did it again. I can't believe it. I do it all the time. No, it's kind of a joke. No, it's a joke. It's a joke, Erik. Don't worry. It's a joke. It's a joke. It's an inside. No, it's an inside joke with me and the Going Long family. I do it every time. Don't worry. Don't worry. Don't worry. Don't worry. I can breathe now. No, here's the thing. What I really have noticed about really successful people is everybody, number one, makes mistakes. Everybody makes mistakes. Really successful people make probably 10, 20, 30 times more mistakes than most people. And whether you call it a mistake, a learning opportunity, a learning experience, whatever.
Right.
The fact of the matter is that always, whenever anything is ever really relevant, they always take a moment to stop, learn from that experience, and then they put strategies, tactics, and actions in place to minimize the probability of that exact same thing happening again in the future. So I don't want you to think about the mistake or the learning opportunity. What I really want you to think about, Erik, is what is the one lesson that you learned as a result of living that experience that you can share with me and the Going Long family today so that we can minimize the probability of that exact same thing happening to us?
Sure. So I'll give you a real estate example. When I moved from Virginia to New York, I was talking to my wife and I said, hey, let's keep our house in Virginia as a rental. We'll move to New York. And she was like, okay, that sounds like a great idea. Let's get a management company. I'm like, no, we don't need a management company. I got this, honey. I got this. And moving to another state, of course, I didn't do a background. This was my first go into real estate. Didn't do a background check on the new tenants. Seemed like great people. They came and met with me. We sat down and talked. They had a great story, nice people. Yeah. We moved to New York. They pay rent for the first 2 months, and then I never see rent again after that. And of course, they knew I was in New York. I couldn't come knock on their door. And so long story short, we ended up getting our money eventually. But the lesson learned from that, which I think applies to all business situations, is know your expertise and then hire and build your team around it. I'm not a property manager. I didn't even know about background checks. I didn't know what options were available to me. And so every property going forward, obviously I've had a property management group who's a professional, who knows what to look for, who knows how to do background checks, who knows how to evict people. The whole eviction process of trying to get those people out of there was a nightmare because I didn't know what I was doing. And so lesson learned, and it goes to what I do now in terms of, the company here is, I'm not a marketing person. Hire a marketing person. You don't want to see my marketing material. Trust me. It looks like my kid did it on an iPad or something. So know what you're good at and know what you're not, and stay in your lane, I guess I'll say. If you're a salesman, or you are if you help raise money for syndication deals, raise the money, but then let somebody else come in and manage it. Let somebody else come in and market it. And I think I've noticed in my short-term, career and in business, those people who know and can admit and say, I'm not a marketing guy. Guess what? I'm not a finance guy. I've got somebody who handles my finances, but I am a salesperson, or I am a syndicator, or this is what I'm good at. Yep. Build that team around you. And we kind of touched on that with the tax preparer versus a tax strategist. And, that's probably the biggest. I'll just share one other quick story.
Yeah, sure.
I was 18 years old. Was working, didn't have a ton of money. I wanted a nice stereo in my car. So I go to the stereo shop, I buy a stereo. They're like, do you want us to install that? I got it. I'm not paying the extra $150, right? I got this. I can install that. 3 days later, after ripping my car apart, I'm trying to figure out how to get a wire from the battery to the trunk. Yeah. I'm like ripping carpet out. I'm doing all these things. I had to call them back and say, how do I get this battery? Long story short, I installed it myself. 6 months later, it started shorting out, and I've never installed a stereo again because that's not my lane, right? You guys could have done it for $150. They would have been done in 2 hours. It took me 3 days. The results were horrible. It started shorting out after 6 months. And so, again, hire a professional, stay in your lane, and do what you're good at.
Yeah, I love that. And it's resonating with so many people today. And then probably at the end of that story, if you would have gone back to the exact same place, they're going to charge you $150 before, it would probably cost you $450 at the end when they say, "Oh, here's Eric. Here you go." 6 months later,
fix your mistakes and install it correctly. Yeah, it would have cost you double. So,
No, I appreciate you sharing that. And then, lastly, is really about helping us to feed the mind before you head out of here. What is the one book that you would recommend to the Going Along family?
Yeah, so there's a book called Tax-Free Wealth by Tom Wheelwright that has been an excellent book. I've read it multiple times since I've been with this company, but really talks about, and this applies whether you're here in the States, a lot of these same provisions or same ideas, concepts apply wherever you are in the world. But the tax laws typically are written for what the government is trying to accomplish. And so they want people to invest in real estate because it creates jobs, it creates all kinds of stuff. And so understanding the tax law, and again, I don't know how it is in Spain, but here in the US, the tax code is thousands of pages and it's very complex. And so being able to understand or try to simplify that complex tax code, it's not that these are some tax loopholes. It's that cost segregation, depreciation is understanding the tax code. This is what the government wants us to do. And that's why they're incentivizing us with this bonus depreciation and these other things, because they want to stimulate the economy. And so great book. If you haven't read it, highly recommend reading it. Like I said, even, no matter where you are in the world, I think a lot of the same policies apply. And great read. Yeah,
Tax-Free Wealth will definitely include that in the show notes as well. And yeah, I mean, it is the roadmap, basically saying, hey, listen, these are the jobs these are things that the government or governments do not want to do, and this is the roadmap to how you can help. And so if you're willing to do that work and follow the path and get the right strategist on your team, the right professionals and specialists, then guess what? You can do your part to really helping out. So, I can't, it's one of the things that I love about being able to host this podcast, Erik, is that I get to meet amazing people like yourself. And the thing that kind of frustrates me is these conversations go by like super fast. It's like, I can't believe we started, like we've been talking for a while. So, but I think about what you've been able to help us do from the very beginning, just understanding cost segregation, what its role is, once again, in being able to help everyone to accelerate their ability to achieve their freedom through long distance investing. And of course, we like to talk about it here, through whatever investing that they want to be able to do. You've helped us understand what can be depreciated, what can't, and then those of those things that can be depreciated. You've talked to us about the different schedules, the 5-year, the 7-year, the 15-year, and then the 27.5 or 39-year, or whatever the case may be. You've given us frameworks to think about. You've given us some very practical examples as well, and ideas. You've given us the possibility to reach out to you for a free assessment, which I think is absolutely fantastic, so that that person doesn't need to know if it's the right thing for them to do a cost segregation, but more, as you said, it's about when they want to be able to do that. You have also absolutely helped us understand some concepts, like when you're going to sell your property, this whole thing about recapture, how that could impact you or not. And then, you know what, you even have your Italian roots, which I think is really, really awesome. So listen, I know that there's so many people, Erik, that are thinking to themselves, I want to get in touch with Erik. I want to find out more about what he's doing, how he could potentially help me, what's going on over at Cost Segregation Authority, LLC, et cetera, et cetera. So help us understand, what is the best way for the Going Long family to reach out to you and find out more about how you could potentially help?
Sure. So visit our website. It's just www.costsegauthority.com. My contact information is on there. I'll give you my email. It's just Erik with a K, ERIK @costsegauthority.com. Also can be reached on LinkedIn. We've got a LinkedIn profile and check that often. So feel free to reach out to me on LinkedIn. Please use us as a resource. We're kind of a niche accounting firm. We're not going to bill you by the hour. If you've got a question on depreciation, give me a call. Happy to answer, happy to be a resource for either you or your CPA or both. So feel free to reach out, definitely.
All right, fantastic. So costsegauthority.com, and then Erik with a K @costsegauthority.com is the best way to contact you. Going Long family, I'm going to ask you this question, but when you reach out, not if, but when you reach out to Erik with a K, Oliver, on LinkedIn, please let him know that you heard or watched this conversation, so that it's going to make it so much easier for the two of you to continue the conversation, because you have context. Erik has context. And that would be fantastic. That way he also knows that the Going Long family is a family that's very active, proactive in reaching out. And yeah, he's giving you a free assessment as well, and he's available to answer your questions. So with that, Erik, listen, I just want to say on behalf of the entire Going Long family and from the bottom of my heart, man, thank you very much for investing your time with us today.
Yeah, absolutely. Thanks for having me. It's been a great conversation. Look forward to it.
All right. Appreciate it. And Erik, if you give me just a second, I just want to say a couple things to the Going Long family. Once again, hey, listen, you heard Erik Oliver today. He's really helped you understand this concept of cost segregation, how you can use this tool to help you to get to your financial freedom even sooner. So I know you're going to take this and you're going to share it with people. You're going to reach out to Erik and make sure that you say that you let him know that you watched him here, you heard him here. And I'm looking forward to welcoming you back on the very next conversation. So until then, go out and make it a great day. And thank you very much. Freedom! Wow. Don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow, so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.